Hi guys, how are you? My name is One Titanium. Welcome back to Evidence-Based Economics and Investing. Um, I want to talk about the Fed balance sheet being talked about that it will be reduced in September. It will start to get reduced in September, possibly. And what it all means when you put it all together. Okay, so I have a chart here from Bloomberg which shows the quantitative easing that started in 2008 and then again in 2010 to 11 and 2012 to 14. Okay, and then interest rates started to come into play. Now we're essentially at 4.5 trillion dollars. During that time, the interest rates since before the financial crisis in 2007 were around 5%. And since all this quantitative easing and so on has taken place, the interest rates has come to as low as 1.57%, and then today it's 2.3%. Consumer Price Index, which is inflation, we started out in 2007 around 4% or so. It went as high as almost 5.5, and as low as in 2015 as going negative, slightly negative. Okay, and today we are roughly at about 1.6%. Also, when we're looking at domestic demand growth, you can see that the average was around 5% prior to 2007, and since we are slightly under 2.5%. At the same time, when we look at the G20 inflation, it doesn't go back far enough to 2007, but it was much higher. It has been consistently falling. Okay, and again we see that around 2% in the G20 Consumer Price Index, which is inflation. When we look at the European interest rate, you saw it went from 2.4 to 1.3. Okay, and unemployment has remained high. Okay, very little change in unemployment. So price stability is the name of the game. You know, the Italian went from 6 to 2%. The German 10-year went from 1.32% to 0.55, and the credit spread went from 2.36 at to 0.93%. Okay, so the balance sheet has increased by 1.1 or 1.2 trillion, and the euro-US dollar has fallen during this time. Stocks, on the other hand, have gone from 21.59 all the way up to 34.91. Okay, so you see that price stability, low inflation, low interest rates, what they tend to do is create a higher stock market because people are chasing yield. Okay, when we look at the volatility index, the VIX, for the S&P 500 in 2007, we were at around 9.3, and since the great financial crisis, it has steadily declined and now has been in complacency land with little fear for an extended period of time. We have to assume that if price stability remains, that this will also remain. But as the Fed starts to unwind the balance sheet, then we have to start thinking, okay, what does this mean for the markets? What could this possibly do? And we'll talk about that next. Before we talk about it, let's look at the S&P 500 since 2007, and you saw we had the big drop, and then we have been in a steady rise in stocks. Okay, so how is unwinding the Fed's balance sheet going to affect the stock market? Well, let's see what we do know. Under quantitative easing, what we saw was that the cost of borrowing has declined. Inflation has also declined. Okay, that's just facts. Okay, can we expect the reverse to happen now? I don't know. Okay, and I'll explain to you why. But before I continue, let's talk about QE. What is QE? QE was essentially the Federal Reserve printing money out of thin air going out into the open market, exchanging $10 of cash for and buying a bond. Okay, so if you're sitting there and you own a bond, and give you some arms here. If you owned the bond, basically what you did is you sold it to the Fed. Okay, you got those dollars. Um, the Fed took your bond and put it back on its balance sheet. All right. Now you don't receive that interest payment. The Federal Reserve does. Okay, but because the interest that is earned from the interest that is earned from the Treasury to the Fed, it is required by law that the Federal Reserve uh, remits that money back to Treasury. Okay, so the interest payments are not going to the private sector, but instead to the Fed. But the Fed has to remit that cash back to Treasury. So in effect, it reduced the deficit. All right, even though, let's say it was spending 400 billion, okay, to service the debt. Um, if 1/4 of it was going to the Fed, and then the Fed was taking that cash and remitting it back to government, then that 100 billion, if you subtract it, the net effect on the deficit is 300, because that 100 billion was an income to Treasury. Okay. Now, when let's say that all of it gets wiped out, then this gets wiped out, this gets wiped out, and then all the extra 100 billion will go to the private sector. Now, you would think that that's good because deficits are now going all to the private sector, but as the last 40 plus years has proven, that interest earned in bonds does not flow back to the functional economy. Okay, that just doesn't happen. So you'll have now the government issuing bonds. You're going to have the Federal Reserve issuing bonds.
Before this battle's over, the world will know that few stood against many.